Ladies and gentlemen, and others, welcome to the first online meeting of Econ 102 in the spring semester of 2020. None of us expected this when we got started with this class, but such is life. So let's do it as well as possible. Now, you will recall that we started with national income accounting, talked about prices, talked about the labor market, then talked about growth, in particular in the context of the solo model, then talked about a very basic short-run national income determination model, the expenditure model, then began talking about money. So before the break, we spent quite a lot of time talking about the monetary history and the history of money. Recall that we said money is the medium of exchange. That's what we use to do transactions. That is what is accepted as a payment. It's a unit of account. When you go to a store and ask, how much is this, right? No one asks you back in terms of what. Everyone understands that we're talking about monetary values. And it's a store of value. Money today keeps on being money tomorrow, right? In conjunction with this, we talked about the beginning of money as commodity money, mostly gold and silver, or their combination. And we talked about the standardization of money, how first money was standardized in terms of the purity, then in terms of the weight, how change was created by clipping coins, right? And along with this, and this is a joint history, we talked about banking. We talked how the first banks were founded as safe houses. They were really places to store the precious commodities, and the owners of those commodities, the depositors today, paid the banks for that privilege. That's very similar to the maintenance fees we still pay to the banks. But since the gold was there, it became natural for people to ask the banks for loans. The depositors wouldn't consent to this. It was their savings that were being lent out. So the deal was the bankers would have the expertise in choosing who to lend to. The depositors would in return get some of the returns the bankers did. That is, the bankers charged interest on lending and then passed on some of this interest to the depositors. So now we understand that banks provide two services. One, the service of keeping your money safe. Two, the service, and this is a more important one now, far and away more important one now, the service of matching your savings with the needs of someone who needs to borrow. It's the matching of savers and borrowers, but very importantly, it's not matching one saver with one borrower, right? No one has ever told a depositor, oh yes, you want to withdraw your money, you can't do so because the person we lent your money to, well, that didn't work out so well, right? The bank does risk pooling, and essentially all deposits fund all lending. And therefore, by the law of large numbers, of course, some of those lending doesn't pay back. They turn into what are called non-performing loans. But it's okay because as long as, let's say, 97% of the loans pay back, the bank can pay you back, right? And that number is actually much higher than in terms of non-performing loans, right? Even if more than 3% doesn't pay back, the bank is okay, you'll be paid back. And in further economics training, you're going to learn a lot about these things. But the bank, the primary purpose of the bank now is to provide what we call intermediation services. The bank brings together savers and borrowers. That is how savings become investment. Good. With this, we talked about the fractional reserves. The bank issues demand deposits. On the one side, there are people who do not know when they will need liquidity. And we talked a lot about the importance of liquidity. Remember that liquidity is moneyness, right? Liquidity is what of value do you have that can be used to fulfill your obligations quickly? What fulfills obligations is money. That's how you pay your debts with. Some things are very easily and quickly convertible to money. Government bonds, which we're going to talk about now. Some other things are also fairly easily convertible to money. Standardized gold. Some other things are slightly less easily convertible to money. Lumps of gold. Some other things are much more difficult to convert into money. Your house. Some other things are even more difficult. If you have a very specialized equipment, for example, it could be very valuable, but it will be very valuable to you. Surely there is somebody else to whom that machinery is also valuable, but finding that person, agreeing on the price, being able to sell it, those are slow things, right? Similarly for artwork, for example. So the distinction between things having value and things being used to fulfill obligations is very important. The latter is liquidity. And it is something extremely important, and once again, extremely important today, right? Because in a world where uncertainty has gone up, people don't know what is happening, people don't know how long their shops are going to be closed, for example, right? Everybody wants to be liquid, but that means they're trying to sell everything else. And we are seeing the effects of that. The other concept that we talked deeply into was solvency. Solvency is whether you have things of value that cover your obligations, whether your assets are sufficient to cover your liabilities. Understand that you can be solvent but illiquid, and this is something very common. I have things of value, but these things can't be used to pay my debts now immediately. They are not liquid. This is something that applies to banks all the time. It's in the nature of banking. Banks issue short-term deposits. They fund themselves with short-term deposits. Their liabilities are short-term. And then they give long-term loans. Why? Well, because I'm going to build a factory, and a 1-month loan isn't going to do it for me. I need a 3-year loan. I will get a 3-year loan. But when you're lending to your bank, when you are making a deposit in your bank, you don't know when you're going to need the liquidity. And one of the services the bank provides is telling you that that's fine. As long as not everybody needs liquidity, right? I can keep some of this as reserves. And this is why bank reserves exist, and lend the rest. Now, this worked well, but it creates a maturity imbalance, maturity mismatch for banks. This is something we understand well, and we talked about this in detail. You will recall. This is a refresher now, right? We all know that the bank is solvent but illiquid. This leads to multiple equilibria, and we worked out those two equilibria. One is where everybody thinks, everybody else thinks, right? And so on. The bank is fine. I'm not going to rush to the bank and try to get my deposits out. And other people won't do this either. Since nobody is doing it, I won't do it. I won't do it. Other people won't do it. We have an equilibrium. This is good. But if for no reason, I suspect that others might be on their way to the bank to withdraw theirs, and only the first few people are going to get their money out because the bank is illiquid, then I will want to be in the front of that line. So I will go, and I will go faster, and everyone will. And we're going to end up with a bank run. And we told how this happened repeatedly in history. And in fact, the last time was really a decade ago, in the 2008-2009 crisis. This did happen. And there was talk in the UK that there was a bank run in the UK for the first time since Victorian times. But it has happened because at the time, during the Victorian times, banks were illiquid. Today, banks are still illiquid. It's in the nature of banking. But that repeated bank runs on healthy banks led to formation of you could think of this as a bankers association that provides liquidity to banks in need, a lender of last resort, a central reserve. That's the birth of central banking. Central banks were not government institutions when they first came about. They were really bankers associations. But what happened then was these institutions began to take on more roles, more duties, and in the end, they became the central banks that we know today. They became the sole issuers of banknotes. And remember that today's banknotes are what are called fiat money. That is, they are not backed by anything. They are not backed by gold. They are not backed by actually anything other than the faith of the people in the money. Okay? Money is money because we treat it as such. Now, once we talk about money, which we have, we want to talk about monetary policy and central banking. To do so, what we need is to understand if we are not holding our savings in money, what else can we do? What is the opportunity cost? Okay. So there are two ways of doing this. And understand that holding your savings as money and holding your savings as demand deposits are more or less the same thing, because money is immediately available for you to make your payments. Your money is in the bank in demand deposits. Vadisiz mevduat is exactly the same. Money in your pocket has no return. Demand deposits also usually have no return. But we could do other things. What else could we do? The basic, what we think of as opportunity cost of holding money. That is, if we weren't holding money in our pocket, what else might we be holding? What would we be using as our basic vehicle for saving is bonds. Now, you'll be tempted to think in Turkish of these as bono, which is not exactly wrong, but slightly wrong. First, let's talk about what a bond is, and then talk about the nomenclature. A bond is really a piece of paper, which isn't anymore a piece of paper. Nobody has been printing these anymore. They don't exist in Turkey either. They're just electronic entries. But for the sake of this example, and for teaching these, treat these as the bonds of the olden times, okay? A bond is this. It's this piece of paper that promises a payment in a future date. So it says, let's say this is 1,000 liras, okay, on March 23rd, 2021, right? I'm gonna look at this, and what I see is a promise to make a payment a year from now. All right? Now, I could issue this. Consider me as the issuer of this bond, okay? Why would I be doing this? Why would I be giving people this paper that says, if you bring me, so let's make this my paper, right? Okay. With this seal, it's now an authentic Refet bond, and sözümüz senettir. When you bring this to me, I will pay you 1,000 liras on this date, a year from now. Why would I be giving this out? The answer is I wouldn't. I'm not going to hand it out for charity or give it as gifts to my friends, right? The reason why I'm issuing this is a term. I am the issuer of the bond. İhraç eden benim. Is that I need people's savings now. Since we do this accounting in money, I will say I need money now, but do understand, I never need money actually, right? Because what I need is either I want to eat, but I don't have something to eat, and I don't have something to give in return, so I need to borrow. Or I'm going to do investment, but I don't have the funds to do investment. I don't have the bricks, I don't have the machinery, okay? So what I'm going to do is I need other people's savings. Understand that money, economists use this frequently, money is a veil. We think of things in money, but what really matters isn't the money itself, except when there is a liquidity crisis. Because since money is the medium of exchange, which is what we use to fulfill our obligations, then you actually need money as it is, because you have a contract that says this person on this date, or if these conditions happen, will deliver this much money. In that case, you actually need the money itself. That is where central banking becomes very important. And that is all this fuss about central banking now. Okay? But in general, when I say, when you ask me, oh, why are you walking to work but not driving? And I say, I don't have money. Okay? What I'm really saying is, I don't have gas for my car. But since I buy the gas with the money, I simply refer to the money itself. Okay? So here I issue a bond. But I really want you to understand that everything we talk about is as correct in a world where there are only potatoes and no money, as in the monetary world we're living in. I can easily issue a bond that promises 1,000 potatoes, but why would I issue a bond that promises 1,000 potatoes? And now is a very good time for you people to begin chiming in through chat. The reason is, my friends, I need potatoes now, right? So I'm not going to give this away. I'm going to sell it. The whole point of issuing a bond is to sell the bond now so that I will have funds now and I will pay back later. This is a borrowing instrument. I borrow from you, but I call it, rather than a loan, a sale of a bond. So what happens? What happens is I come out today on March 23rd, 2020, and say, here is a Refet bond that pays off 1,000 liras on March 23rd, 2021. Okay? And I'm selling this. At what price would you buy it? Injoxo here says, nice. Very good. Okay, so we have prices. And you see the chat too, right? And we have something very good. Okay, stop now, and thank you very much. So a couple of people said less than 1,000. That's right. Usually, right, for a future payment of 1,000, you want to pay something less than 1,000. If I were teaching this a decade ago, I would have said always. But now we see these things traded at prices of higher than 1,000 a little bit. And we're going to talk about this either today or on Wednesday. But what happened through chat immediately was a sort of auction, right? I see prices. I asked, I'm selling this, and somebody said 800, Allah'tan kork. Okay, that's an insane interest. Somebody said 700, Allah'tan duble kork, right? 850, 910, 950. Now, who is going to get this? Who am I going to sell this to? That's an easy one, right? Obviously, I'm going to sell it to the highest price, 950. Yes, very good. All right. And indeed, this is how these things are sold. Treasuries, so countries borrow this way. The way the Turkish government, for example, patches its budget deficit is to issue these things. And the way you issue it is actually fascinating. Those of you who are economists, when you take further, more advanced microeconomics classes, you're going to learn that doing an auction the way we just did, that is, I come up here, wave this thing and say, okay, this is for 1,000. How much? I see 700. I see 800. I see 850. Nobody says 900. That's not the way, or that may not be the best way of doing this. Okay? There's what is called the second price auction, where you tell people, I will tell you this for the fun of it, okay? You're going to find this quite fascinating. One could prove that under certain conditions, this auction is not going to work. And it's not going to work under several cases. One, it may be physically impossible to do this, okay? Maybe you can't bring these people together and do this, ongoing auction, okay? So you have to tell people in advance, just write down what your bids are, and I'm going to open these, and I'm going to pick and sell to the highest bidder, okay? This is a common way of doing auctions. Some smart economists then thought, let me think of the incentives this provides. The problem here is anyone submitting a bid will fear they don't really know the preferences of the other people, right? Now, if I could do this exact way, usually what would happen is you would say, let's say 900, and I wouldn't say 950. I would say 901, right? So when all the bids are opened and I see that I bid 950 and the next one isn't 949, it's 900, I'll feel fairly stupid. So I have an incentive to lowball my bids. But if everybody does this, then the price goes down. One way of solving this problem is to say, I will sell this, and this is not only for government bonds. This is a common way of doing auctions that economists have devised. I will sell this to the highest bidder at the second highest price. This is called a second price auction. If we had done it this way, what I would be telling you is, okay, all of you simultaneously tell me at what price you would buy this. I will pick the highest, and that person is going to get the bond. But then the price that person is going to pay is going to be the second highest price. So if you bid 950 and the next is 900, you will actually pay 900 and get this. This gives the incentive to the people to bid their true values, okay? And usually increases the price in an auction of this sort. So several treasuries use this and have used this. The problem is the public isn't all that well educated in economics. And so at some point, somebody realizes that this is the auction going on, and somebody begins to write newspaper articles, or some opposition party begins to whine that, look, here was someone who was willing to pay 950 for this, and the government sold this for 900. That's clearly a loss. It's a shame. These people are idiots, whatever. So it's not an easy thing to do, because you have to explain people, equilibrium dynamics and the incentives and how the auction structure changes the bids themselves and whatnot. It's not always an easy thing. But anyhow, we have the bond for 1,000. It is sold for 950. The question now is, why did this person, so this is Seraj, why did Seraj buy this for 950? What else? I assume, and I vaguely remember this is a man, but if I'm wrong, my deepest apologies. Why did he choose to pay 950 for this piece of paper? Okay, so here is a correct but useless answer. You must be an economist. They thought it is worth it. Sure, that is the only reason why people fork out money for things. But why did he think that this is worth 950? And as he says, for its future value, yes, the future value is 1,000, right? Essentially, somebody thought, let's see, next year's 1,000 liras is worth 950 liras to me today, okay? Yep. Okay, so you see these answers too. These are all fine, okay? Many of these are tautologically correct. That is, for example, no other better option. Of course, it has to be correct. Otherwise, he wouldn't have done it. But why is this the best option then? What makes this the best option for anyone is the question, right? And yes, it's the time value of money and it's the opportunity cost. The opportunity cost is better taught from the alternative. That is, if you did not buy this, you had 950 liras. What can you do? Well, you can do one of two things. You can buy this, or you can sit on it, keep it in your pocket, okay? Keeping it in your pocket has value in the sense that for a year, you can still spend it if you need to, right? On the other hand, at the end of the year, assuming you haven't spent it, you're still going to have 950 liras, okay? But if you bought my bond, then today you wouldn't have the 950 liras, but at the end of the year, you would have 1,000 liras. So essentially, what you are transacting is the right to use your savings for a year against having more money a year from now. You are selling me the right to use your 950 liras for a year and the price is 50 liras, right? Because you give me 950, at the end of the year, you get back 1,000. That difference, 50, is the price I pay to use your savings for a year. That price has a name. What is that called? That is exactly right. That is the definition of interest, files. This is why interest exists. We are doing transactions over time, okay? That is the key thing. You're giving me something now, you're going to take it back later. And for us, for humans, now and later are not the same thing. We value the future less than we value today. You remember the exercise we did. I asked you, assume that you're going to be happy and it's going to be the same happiness. You're just going to feel giddy for a second. It's going to feel beautiful. Would you rather feel this way now, or would you rather feel exactly the same happiness 20 years from now? And you all said now. This is something economists do not study. We take it as given from psychologists. But psychologists do study and tell us that, yes, this is the way humans are wired. We like, in our words, utility now more than utility later. Thus, if I make you transfer your utility from now to the future, if I tell you, don't consume now, give your money to me so that I could consume, I could invest, I could use your savings, okay? Postpone your use of your own money, then you're going to say, but that postponement isn't without consequences. If I postpone, the person who is going to use these is going to be 1 year later's me, tomorrow's me. Of course, it's still me. Otherwise, I would not have saved at all. But I don't value my own future self as much as I value myself now. I don't value, consumption a year from now as much as I value consumption now. Okay? So if you're going to make me postpone, then you have to compensate me for it. You have to make up for the difference. How do I do that? That's interest. Okay? That is why interest exists. And in fact, in all over-time transactions, even those who carefully avoid being labeled interest, as an economist, we're going to look and see compensation for time. You're going to be paid more in the future than you paid now for lending. And we're going to look at that and say, that really looks like interest. Otherwise, this transaction wouldn't have worked out. So this is interest. Now, a very important thing to understand about bonds is the following. A bond is what we call a fixed income instrument. Fixed income. Why fixed income? It's going to pay you 1,000 a year from now. It's going to pay you 1,000 on this date. Irrespective of how much you paid for it, you will be paid 1,000 in the future. Fixed income. Türkçesi sabit getirili. Bu tür şeyler için özellikle sabit getirili menkul kıymet. Şimdi sabit getirili tarafını anlıyorsunuz bunun artık. Nihayetinde getireceği 1.000 lira. Kıymet olduğunu da anlıyorsunuz. Menkulü de anlıyor musunuz? Meanwhile, when I was talking about, yes, future values, present values, future utility, present utility, Deniz has said gratification. That's exactly the right word to use. Let me go back to the Turkish terminology here for your information. Menkul ne demek? Bravo. Taşınabilir. Tahmin ediyorum bunun kökü nakildir. Hatta dur, evde olduğum için bakabiliyorum bile. Bir dakika ya, böyle ders yapmanın çok güzel tarafları varmış. Ayrılmayın, geliyorum. Menkul. Ha, bravo. Gerçekten de nakilden geliyormuş. Tamam. Menkul taşınabilir demek. Dolayısıyla mesela bizim borsa diye bildiğimiz yerin adı İstanbul Menkul Kıymetler Borsası'ydı. Bu tür şeylerin alınıp satıldığı yer. Şimdi mesela gene şuradan da anlayın. Bir fabrikanın kendisi taşınabilir değil. Fakat fabrikanın üzerinde hak iddia etmenizi sağlayan bir şey taşınabilir olabilir. Buna menkul kıymetleştirmek deniyor. Hisse senedi bir menkul kıymet. Hisse ne? Fabrikanın belli bir hissesini, şirketin belli bir hissesini, belli bir kısmını satın alıyorsunuz. Onun size ait olduğuna dair bir kağıt var. O kağıt taşınabilir bir şey. Menkul olmayan şeyler de var. Onlara ne diyoruz? Taşınamazların da, bravo, gayrimenkul. Aynen öyle. Tamam, güzel. So we're good with the language here in English and in Turkish, okay? But it's important to understand the fixed income nature of this. This is something you have to keep in mind all the time to understand the relationship between interest and bond prices. What is the price of this bond now? At what price was this sold? I want you to be a bit faster here so that we can do class. That's right, yes. I sold this for 950. How much interest will Seraj Bey get in return for this? Ah, wait, stop. Muhammad Abdullahi has said 5%, and he is wrong. Because interest rate, he noted an interest rate. Interest rate is calculated as interest over price paid, okay? So I asked the question correctly. How much interest will he get? And the answer, as many of you wrote, is 50, okay? 50 is the amount of interest you get. What is the interest rate? That's exact, bravo. I assume this is correct. It seems right, okay? The interest, this is interest, okay? The interest rate is 50 over what? Is 50 over, from my perspective, from the buyer's perspective, right? I paid 950, got 50 interest. So the interest rate is this, okay? So this is going to be 0.05 something something, right? So usually we report this in terms of percentage points this way, right? Yes, exactly. That's 50 over 950. So now here's what I want you to understand. I'm going to ask the question the difficult way. This being this bond being a liquid instrument itself, okay? Do you have to keep this for a year? Or if it turns out that either you have better things to do, or Allah korusun, you know, you had a health scare, it's the thing these days, right? So you need your money to pay for health services, medication, whatever. Or you just felt like it. Or you realized that there are other better options for your savings, and you want to turn your bond into money so that you can use the money for other things, okay? Can you sell this? Is this piece of paper still sellable on March 24th, 2020, tomorrow? Yes, of course, okay? This is called a secondary market. In Turkey, the organized secondary market is Borsa Istanbul. And all of these places, Turkey actually does these things better than many other countries. So, for example, the New York Stock Exchange, notice that the word stock is in there. Stock is, it's hisse senedi. Stock is the shares of firms, okay? New York Stock Exchange is for stocks, okay? And the US actually does not have an organized market the way we have a formal exchange for bonds. Bonds are what are called OTC, over the counter. That is, you have to call up a broker dealer and say, I have this bond to sell, would you find a buyer for me? And other people would be calling the same institution, but there are many such institutions, so they call each other and they make a market, okay? This is not the, in many times, in many situations, not the best way of doing things. The Turkish way is to say, well, you know, stocks, menkul kıymet, bonds, menkul kıymet. Well, these are similar in terms of being tradable securities. Menkul kıymetin İngilizcesi security. These are all securities. And since we have an exchange for one kind of securities, we can use it to exchange other kinds of securities too. So in Turkey, bonds are exchange traded. They are traded in İMKB. And you can see their prices if you go there. And in fact, you will have a homework that will ask you to go there and take a look at those prices. Now, when you sell it tomorrow, okay, let's assume that the world has changed. Okay, you told me, and I believe you, that this is 5.26%. Okay, now let's say something happens tomorrow and the interest rate goes up to 10%. So if people lending on the 24th of March, okay, lending for 10%. First question, if you buy this on the 21st of March 2020, what is the maturity date? Note this terminology again. It's the maturity date. The day the bond matures and pays off. Okay? Türkçesi vade. Bizde itfa tarihi denir. Tamam? Şöyle şeyleri gazetelerde görürsünüz. Böyle yazmaz gerçi ama dil doğru tam kullanılmış olsun diye cümleyi böyle kurayım. Hazine şu tarihte ihraç etmiş olduğu bonoyu, şu da ihraç tarihi, yarın itfa edecek. Demek ki yarın itfa ediyorsa şimdi 22 Mart 2021. İtfa tarihinde artık bono ödemesini yapıyor. Tamam? So, on the initial sale date, the seller takes the money. On the maturity date, the seller pays this. This is called face value, okay? Or principal. It pays the principal back. So on the maturity date, we see the payment from the borrower to the lender, all right? But if I buy this in some intermediate date, not on the day it was auctioned the first time, okay? But a day later, a month later, half a year later, whatever, okay? What happens to the maturity date? Does it change? No is the right answer, right? It says this is the March 23rd, 2021 bond, okay? And usually we name these this way, by their maturity dates. And what happens there is this date stays fixed. So on the day that I issued this, since it's today, it's exactly a year, right? If you buy it a month from now, then you will be buying this as a 11-month security. 6 months from now, you're going to buy it as a 6-month security, right? 9 months from now, you'll be buying it as a 3-month security. You get the picture, okay? But it has to be clear to you that as we get closer to the maturity date, the price will converge to 1,000. On the maturity date, on March 23rd, 2021, what will be the price of this? That's right. That's exactly right. On the date this matures, this is 1,000 liras, right? When is it 1,000 liras? If this is March 23rd, 2021, right? Today it's 1,000 liras. Well, what is 1,000 liras today worth? It's worth 1,000 liras. So on the maturity date, the price is going to be whatever it's paying on the maturity date, okay? This one pays 1,000 liras. Therefore, on the maturity date, the price will be 1,000 liras. The day before the maturity date, it will be very close to 1,000 liras. You can see that, right? But how about tomorrow? Is it clear that this has to monotonically and uniformly converge to 1,000? Do I know the price of this thing at every future date between today and the maturity date? Okay, so we have this agreement, and Salih Bey says no, and a lot of other people say yes, but Salih Bey is right. Because think of the example I gave you. Let's say the world is different tomorrow. Let's say, for example, we were told tomorrow morning that The day after, all shops will close for 2 months. Do you want to hold this bond, or do you want to sell it and buy groceries? Okay. Salih Bey is an interesting person. So he's going to hold it, and you're welcome to. Maybe he has a lot of money already, so he doesn't need to sell it. But most of us will have to sell this. Okay. But notice that there are a boatload of people who are saying, okay, stop it. Yes, right? You know, sell, sell, sell. Yes, fine. And this happens in market, right? You know, we have these moments of sell, sell, sell. But if everybody is selling this bond, what is happening to the price of the bond? The price is decreasing. That's exactly right. Yes, yes, yes. Very good. Surprisingly, you are more articulate and open with your opinions on an online class than in class. And that's probably, I can come next to you and probe you with it. But I'll find ways of doing that as time progresses and I get more acquainted with the software. Now, well, thank you for this. The price will decrease. So tell me a price. At what price are you buying this now? Okay, so Dennis Bey is buying this at 850. Let's make it 850, okay? For the fun of it. The new price is 850, okay? The price of the bond. What is the interest? When you buy this for 850, how much interest are you getting? That's right. Higher, of course higher. You're getting 150, right? What is the interest? What happened when the price fell? What happened to your interest income? It went up, right? When the bond price fell, the interest income went up and the interest rate, somebody helpfully already wrote this here, the interest rate went up to 17.6%, okay? That's a lot. Now tell me why this happened. Why is it the case that when the bond price fell, the interest rate went up? That's right. Very good. Araz is very correct. In fact, in a slightly, you already told us sense, he wrote, it's fixed income, duh, yes, right? Equally helpfully, Dennis Bey said, I know there is a Dennis Bey in this class, and I'm hoping that this Dennis is him. Thank you, okay. The face value is the same, right? That is, look, when you pay 950 for this, let's write the price there, right? The initial price of this bond was 950. When you paid 950, you paid 950 to get 1,000 on this date. When you pay 850, you're paying 850 to get 1,000 on this date. Okay? Now, this comes difficult the first time you think of it, because I need more tea. Because what happens is you are used to thinking in terms of standard loans, where the loan specifies this and the interest rate. And this is a free variable. That is, the loan is, you're going to give me this much, and I will pay you back with this much interest on that future date. Okay? So how much you pay today determines how much the future payment will be. Okay? That's a standard loan. A bond is different. A bond, and learn this definition, a bond is a promise for a future payment. We are selling and buying that promise. So what happens is, the less you pay for the same future payment, the more interest you are receiving, and the interest rate is going up. Are we good with this? I will wait for you to think of this for a second, and chime in saying, yes, okay, I get this, or say it again. All right, good, yes. I have a complaint. So I have a whole bunch of, can you say it again, whatever, right? Why do you wait for me to ask whether you get this? Just write it. We are doing class, okay? Cool. Here's it again. A bond is a promise for a future payment. The bond price is the price of that future payment today, okay? Interest is the difference between what is promised to you in the future and what you paid for it today. The less you pay for it today, since the future payment is the same, the more interest you're going to get. When the price was 950, you were paying 950 to get 1,000. When the price is 850, you're paying 850 still to get 1,000. Which one gives you more interest? That's right. That's right. Okay? So what happens? What happens is we have this scare, okay? So now this is happening. In the world markets, there is a bond drought, all right? Maybe we'll do some evening session where I show you my Bloomberg screen, where you can see bond prices of almost all corporations, right? It's not only countries that issue these things. Firms also do so. Those are called corporate bonds. Türkçe'de ÖST diye geçer. Özel sektör tahvili. They have issued these securities, okay? Fine. But now the whole world is in turmoil, obviously, okay? And there are several problems. One, everybody wants liquidity, so they are trying to sell these bonds, okay? Notice that the sellers aren't the original issuers. I already sold my bond, took my money, and doing whatever I'm doing with it, okay? And you lent to me. You are the one buying the bond. Now you are selling the bond to somebody else. But everybody is selling. Everybody is selling. We are all in the same world. Everybody wants to be liquid, and everybody fears, you know, let's say I have a restaurant chain, right? And my restaurants are now closed. Will I be able to pay this 1,000 a year from now? This is called default risk. Okay? What if I don't pay? You thought, oh, the great Refet restaurant empire will surely pay. Okay? But now, suddenly, I was ordered to close all of my restaurants. No business. When this date comes, will I be able to pay? Now there is a risk. Default risk goes up. Your risk perception has already gone up. Your liquidity preference has already gone up. So you're selling this. What happens to the price of this bond? That's exactly right. Okay? It falls. Yes, yes, yes. Okay? Now we see this in the prices of Turkish government bonds, where the government has borrowed in foreign currency. So about half of Turkish government borrowing is either in foreign currency or linked to foreign currency in some sense. And we can see the prices of these things in the secondary market. And we see that those prices are falling like a rock. Why? Well, for countries, it's the same too, right? You know, what is happening to GDP in Turkey now? That's right, exactly, right? Since a lot of firms are closed down because they can't get intermediate goods. A lot of other firms are closed down because they are ordered to close down. A lot of other firms can't do any business because there is nobody out there to do business with. We're staying at home, right? Production is falling and income is falling, okay? But then, let me ask you this. What is going to happen to the government's tax revenues? That's right. The tax income will also fall. If the government isn't collecting taxes, is it going to find it easy to pay this back when the time comes? Right, exactly. And since you're not stupid, you understand this too. And you know that, you know, Turkey is, not the best run country around, right? And how did I know that? The markets, as if this is an animal that has its own mind, right? The markets thought this way. I see the bond prices. I always see the bond prices. I know that, for example, when the US borrows in dollars for 5 years, they borrow at about 0 interest. Okay, Germany borrows at negative interest rates, amazingly. Okay, do you know at what interest rate we borrow at 5 years? In dollars now, about 8.5%. Okay, it's insane. Now, before this crisis happened, we were borrowing at about 5%. Germany was still borrowing at almost negative rates. The US was still borrowing at almost 0. Okay, so if the US is able to borrow in dollars at 0, okay, Canada is able to borrow in US dollars in about 0, right? Why is it that Turkey is borrowing at 5%? It was already the case that, hey, it's Turkey, you know, who knows what's going to happen there, all right? It's a risk premium. That risk premium goes through the roof now. So what is happening to bond prices everywhere? You told me already that they fall, okay? What is happening to the Turkish bonds prices, the government bond prices? They are falling too. What is happening to interest rates? Interest rates are, now you understand, right? The interest rates are increasing. Now, this poses 2 problems. One, for the current holder of the bond. You had bought my bond, right? And I promised you 1,000 liras, and suddenly now you're trying to sell this, right? And all you're getting is 850. Yesterday you paid 950 for this, right? You hate this. This is hurting you, okay? It's hurting me too. My problem is this. I'm, say, the Turkish government, right? And I know that 6 months down the road, this thing will mature. I will have to pay this. And the question becomes, well, how is this going to work out? How am I going to pay this? Usually what I do is I borrow again to repay. This is called rolling over. Türkçe'de borcu döndürmek dediğimiz şey bu. Okay? I borrow again. With the new borrowing, I pay off the old one. Okay? This sounds like a Ponzi scheme. It sounds like I borrow from you, pay you, and then I borrow from him and pay them, whatever, whatever. This shouldn't go on. But understand that a country, especially a country, is not a human being. This is one place where the analogy with a household budget fails. Okay? People die. And when you get closer to death, it becomes very difficult to issue long-term securities. By the time you die, humanity expects you to have paid off your debt, right? They're not going to lend you again into, you know, when it seems like, oh, I'm already 105 years old, I have a bond coming due, it's maturing, and I want to borrow for another 10 years, right? Who is going to lend me for 10 years when I'm 105? Anyone? Anyone? Anyone? That answers my question, right? I can't borrow. But what is the equivalent of being 105 for a country? Countries don't have finite lives, and therefore they can do some things forever, okay? Those of you who are economists, once again, in your next macroeconomics class, you're going to see in great detail under what circumstances you can keep on rolling over this debt, under what circumstances this is not going to work out. It becomes a question of the interest you're paying. It becomes a question of the relationship between the interest rate you're paying and the growth rate of your GDP. As a share of your GDP, is your debt stock increasing or at least non-increasing? Okay? Okay, it broke Melek's heart that no one is willing to lend me when I'm 105. Such is life. Now, the second party that is troubled by the fall in the bond prices, therefore, is the issuer, because many issuers will want to borrow again. And I ask myself, when I borrow, at what interest rate will I be able to borrow? That is, when I sell this 1,000 lira worth bond, okay, how much lending is it going to afford me? How much will I be paid for it, right? And when the answer is 950, I'm happy. But now I look at the secondary market and I see that my 1,000 lira bond is trading at 850. And I understand that I will have to issue more of these. I will have to borrow more or at higher interest rates, or I will find it more difficult to borrow because the market doesn't treat my promise for 1,000 liras a year from now as valuable as before. All right? This is a problem, and this is one of the main problems central banks around the world are trying to solve now. We will talk about that, I hope, on Wednesday. Are we good? Chime in. If you have questions, now is a good time to ask. Okay, excellent. So here's a very nice point. I like this, and you have the mind of a microfinance person. So taking class, the rest of this class from Burçin Hoca will make you happy. He's the grandmaster of these things. Very good. Okay. So Sarar says, despite the increase in default risk, I wouldn't care that much because as long as you don't actually default, in the end, I'm going to get 1,000 anyway. Okay. True. Very true. But you care in two ways. One is in terms of the opportunity cost, right? Yesterday, you bought this for 950. If you bought the same thing today, you would have bought the same 1,000 liras for 850. Okay? That you care about. The risk that this is going to happen again. Let me ask you this. If you think that the price is going to be 750 tomorrow, would you sell it today? See? Okay? The answer is yes. But if you all think that the price is going to be 750 tomorrow, and if you all sold, the price would fall to 750 today. This insight and a proper articulation of that won Fama a Nobel Prize, and I would say a rightly deserved one. I disagree with a lot of what he has to say about markets, but this setting up the baseline is very important. Notice that now that you are being trained as economists, the bane of your existence is, all your friends, and in particular your friends' parents and your extended family, aunts, uncles, whatever go, so now that you're learning economics, what will be the dollar be tomorrow? Right? Yeah. Okay. So it happens. And you have to find a way of properly saying, I don't know. And then you're told something along the lines of aman senin ilmine, right? Yeah. It's not just that we don't see the future, okay? It's that if I know, I'm not the only smart one around. Other people know as well, okay? So this is the Fama way of thinking. If we all know, if it's knowable that the dollar will be 7 liras tomorrow, okay? Surely I'm not the only one who knows this. So other people will have the same insight too. Or even if I am the only one who knows this, then I'm going to beg, borrow, steal, and begin to buy dollars like crazy. Is that not right? But if that happens, then the dollar is going to appreciate. You're going to learn this language later in this class against the lira now. So what's going to happen? The moment we think that the dollar is going to jump up to 7 tomorrow, okay, it's going to jump up to 7. So when I'm asked, what is going to happen to the dollar tomorrow? I will still have to say, I don't know. The knowable part is already priced in. Okay? Now, there are a lot of exceptions to this, what is called efficient markets hypothesis or efficient markets theory of financial markets. But it's a very strong benchmark and one that is really worth thinking about. Okay? So next time you're asked, what's going to happen to the dollar? Should I buy these? Should I buy those financial instruments? Okay, you may as well say, rather than saying, I don't know, it's unknowable. Okay, and then you can get into a fight. Excellent. Okay, so Melek is writing some very correct and interesting questions, but these are not 1 or 2 questions. So drop in my virtual office hours or Take proper econ classes later on, and you're going to think all about these things. That's what economics partly is. Cool. We're good. So this is the bonds. And in fact, now we understand that, for example, looking at the relative values in the same currency of different countries' bonds tell us about the market's perception of those countries. Turkey is one of the countries that borrows at the highest dollar interest rates. That's the world's way of telling us you're not doing all that well. Okay? Very good. Next comes some more definitions and some more basic ways of thinking. I want you to understand some things. We talked about efficient markets, future values, unknowable, okay? We can debate this. We can debate whether this is correct or whether markets are inefficient, and therefore, if you're smart enough, you can outperform markets all the time or not, okay? This really has to do with economic theory in the sense, how do humans behave? How do things work? We also talked about the relationship between bond prices and interest rates, okay? Given this definition of a bond, it has to be that interest rates and bond prices are inversely proportional. This is not up for debate. This is part of the definition. You may have seen, if you follow my Twitter feed, which you don't have to, I wrote something about, what was it? I first said, production and income are the same thing. Since production is falling, incomes have to fall. Collectively, we have to be poorer. And then I said something about, this is more of a supply problem than a demand problem, okay? And various people said, yes, you know, whatever, whatever. Various other people said no, and various other people said, you're an idiot, okay? Now, I may be an idiot. That's very possible, okay? And I may be wrong, but I can't be wrong on the first part of this. I can't be wrong that production and income are the same thing. Since production is falling, incomes have to be falling, and collectively we're getting poorer, okay? That's the definition. It's the physics part. That part is not up for debate. And the people who are saying, oh yeah, you know, this is some basic theories that people like you like to teach, okay? You have to go, you really don't understand the difference between a definition and a theory, okay? Now, if you want to push back and say, no, the bigger problem is the demand problem, and we really haven't talked about aggregate demand and aggregate supply yet, but you understand this language, that is fine. That is something we can and should debate. But we can't debate whether as GDP is falling, income is also falling. They are by definition the same thing. We can't debate as the bond prices are falling, interest rates are going up. It comes from the definition. It cannot be anything else. Are we good? All right, very good. Now comes a bit more. There are some pleasures, in fact, great pleasures of using a blackboard. One of them it doesn't raise all that well, and you get chalk dust all over you. But let's talk about the following. Now we understand that we could have held our savings in money or in bonds, okay? And somebody already used the correct language here, and in chat said it's the opportunity cost. It is the opportunity cost, okay? So the cost of holding money in your pocket, the cost of holding money as money is the opportunity cost in terms of the interest you are losing, okay? That brings an interesting question. Given the price, given the face value, given the future payment of 1,000, can the price of this bond be more than 1,000? Okay, the question, I could repeat that. The question is, I promise you 1,000 liras a year from now, that's my bond, okay? Can the price of that bond be more than 1,000 liras now? All right, so the answers are mostly no and some yeses. And I don't know whether the... okay. Excellent. Okay, stop it. Yes, nice. So Kıvanç says, if Germany has negative interest rate, it must be that the price is more than 1,000. And Kıvanç Bey, you exactly understood the bond pricing thing. Very good, right? Excellent. But the following isn't right. So several people wrote things like, what if there is deflation, okay? Or the value of money now is lower than the future, okay? That argument actually does not work. Assume that there is deflation, okay? Because, you know, when I used to teach this class in 2007, 8, whatever, okay? I used to teach it as a ironclad, it can't be higher than 1,000. In fact, this is known as the zero lower bound, which turned out not to be that much of a bound. The problem is this. Now think in terms of the opportunity cost again. If you did not buy the bond, what would you have? Right? That's the decision you're making. Here are your savings. Your savings are in terms of money. Yes, right? You have money. The answer is yes, money. Okay? You can call it liquidity, but liquidity is money here. So you either are going to have 1,000 liras, or you're going to have a bond that is going to pay you 1,000 liras a year from now. Okay? Now, if the interest rate is negative, then this bond today is worth, let's say, 1,001 liras. Okay? So now you're asking yourself, I have 1,001 liras. I could buy this bond, and if I did so, how much would I have a year from now? That's right, 1,000 liras. Very good. That was obvious. Or I could look at my 1,001 liras, see how lovely they are, right? And say, yeah, I'm just going to hug these for a year. If you did that, how much money would you have a year from now? 1,001. Which one is larger, 1,000 or 1,001? Very good. Smart people. You all see that is the answer is 1,001. Now, okay, now understand the following. Regardless of whether there is insane inflation between today and a year from now, or prices fall, there's deflation between today and a year from now, which one is larger? 1,000 liras a year from now, or 1,001 liras a year from now? I knew you would understand. Yes, right? It's not a problem of inflation. You have to know nothing about expected inflation, expected deflation. 1,001 liras a year from now is always larger than 1,000 liras a year from now. Okay? Whenever I tell you, why don't you lend me 1,000 liras, and a year from now I'm going to give you 900 liras, you're going to ask yourself, well, if I give you 1,000, I'm going to get 900. If I don't give you 1,000, I'm going to have 1,000. I'd much rather have the 1,000. Okay? Okay, let's do it again. If the interest rate were negative, okay, let's assume the case which usually people find more difficult. Let's assume we know there is going to be deflation. Everything will be cheaper next year. Okay? Start from there. I tell you that since everything will be cheaper, okay, why don't you lend me 1,000 liras today, and I will pay you 900 liras. And in fact, deflation will be more than that. Okay? So all prices we know somehow will halve in a year's time. Okay? So by giving you 900, I'm already giving you more purchasing power than today. Okay? Yeah. Deniz Bey wrote my explanation already, but let me do it because I get paid for this. And for a moment, this might sound reasonable, right? Because today with 1,000 liras, I can buy 10 units of things. Since prices will halve, okay? With 900 liras next year, I can buy 18 units. That's better, right? And that's what I'm trying to peddle you. So lend me 1,000 liras in return for 900 liras a year from now. The moment you were going to say, yes, that sounds right, because I'm giving up 10 units of purchasing power to get 18 units of purchasing power a year from now, you're going to think, wait, what if I don't give you my 1,000 liras? Okay? Yeah, Melek, hold on. Yes, even if you get less, you will get more purchasing power. But the question isn't that. The question is this. What if you hadn't given me the money to begin with? Okay? Because your choice now is having 900 liras in a cheaper world next year and having 1,000 liras in the same cheaper world next year. Which one gives you more purchasing power? Exactly, right? Because 900 liras is going to let you buy 18 units. 1,000 liras will let you buy 20 units. Exactly. Okay, now you get it, right? If you don't lend me at negative interest rates, you always have more, regardless of whether inflation, deflation, whatever inflation you want. Okay? Thus, the point is this. This is the nice way of thinking about it. Money itself has an interest rate of 0. It just keeps on being the same money. Okay? Since money has an interest rate of 0, nothing with a negative interest rate should work. All right? This now requires us to define two types of interest rates. One is what we have been talking about all this time, what is called the nominal interest rates. Türkçesi ne? Aynen öyle. Nominal faiz. Okay? Nominal faiz. The nominal interest rate is the interest rate in money. This is what we've been talking about. Okay? You pay me 1,000 now, and you get 1,100 next year, and therefore you get 10% interest. Notice that if you pay me 900 now and get 1,000 a year, although your interest income is the same, the interest rate is higher. The interest is always calculated over the return over the initial investment. This is the financial investment that we're talking about now, not in the sense of fixed capital formation. And what I paid was 900. So it's 100 over 900, that's more like 11%. Good. Can you see me and hear me? All right, I'm back. There was a technical mishap. I am back. Thank you. I'll stop it. Yes, now I see. We were at the point where I said the nominal interest rate is a combined reward for a change in your real purchasing power and changes in prices, right? And that's a problem. So now we want to think of what really happens to the purchasing power, okay? That question is the real interest rate question, okay? Now, as a separate note, in the online classes, we really have to be punctual in ending the class, okay? Starting the class a few minutes later, whatever, this is fine. But as long as we are in this room's account, the next class can't even come in. Or if they come in, they will have to be stuck with learning economics. So at 10:30, I will end this, all right? The real interest rate, what is that in Turkish? Reel faiz is right, okay? Reel faiz. Reel faiz değil bu arada, reel faiz. The real interest rate asks, what is the change in the purchasing power, taking into account the changes in prices, okay? So we have three things here. We have the nominal interest rate, which we usually denote by I. We have the real interest rate, which we usually denote by R, okay? And we have inflation, which we often denote by pi, okay? These are in percent. That is, this is a number like 0.12, that's 12%, okay? This is a number like 0.1, that's 10%, okay? So for the gross interest rates, we look at 1 plus I, 1 plus R, and 1 plus pi to what happens to the price level, okay? And the relationship, which is called the Fisher equation, is 1 plus R is equal to 1 plus R times 1 plus pi. If you do a Taylor series approximation to this, you're going to see that for small I, R, and pi, this is approximately equal to, this was badly said, this approximately implies I is about equal to R plus pi, okay? So usually what happens is I look at the interest rate and I say, okay, in Turkey, last year, I received 18% interest. Inflation was 12%. Therefore, my real interest rate, that is the real increase in my purchasing power, was 6%. Okay? That okay? One set answer. Cool. All right. Now, there are two ways of doing this. One is what is called ex post real interest rate. That means looking back after the fact, after everything is realized, okay? Properly, it is ex post factum, but we, in economics, almost always say ex post, okay? And that's exactly what we did. After, notice what I know. At the beginning of the contract, the moment I buy this bond, okay, I know the nominal interest rate. I paid 950 to get 1,000. Therefore, I'm going to get a nominal interest of 5.26% at the end of the year. Good? Is that good? Yes. And in fact, it's going to be the same 5.26%, regardless of whether inflation is 1%, 3%, 50%, or minus 20%. Is that correct? Let's have an answer to this. Yes, very good, right? Because I have already paid 950. Whatever happens to inflation, I have paid what I have paid. Whatever happens to inflation, the bond will pay the same 1,000. So the nominal interest rate is fixed, okay? But if I sell the bond at a new price, that interest rate will change. But now you understand. How about this one? Let's say I bought this bond for 950. We're going to leave this class at a high point, okay? So pay attention. You're going to like this one. I bought this bond for 950, thinking that inflation will be, let's say, 3%, okay? Then something happened the next day, and we realized that inflation is going to be 10%. Inflation is going up. Okay? I'm selling the bond. Will the bond price stay the same, go up or go down? That's very right. Now you know that the time value, over time, your money is going to lose more value. You're going to want more compensation for that. Therefore, as expected inflation goes up, the bond price falls. When bond price falls, what happens to the interest rate? That's right, that's right. The interest rate goes up. Therefore, you have argued correctly that as inflation expectations go up, as a result, interest rates go up. Causality goes from inflation to interest rates. And that's a very basic, very important introduction to macroeconomics knowledge that every citizen and policymaker should have. Now you have it, think about it, and I will see you on Wednesday. Thank you. This was pleasant. Goodbye.